Warning, what you're about to see is controversial. Many market pundits and the so-called experts are advising the exact opposite of what I'm about to tell you. Discretion is advised. Hi, my name is Elliot Gu. Over 20 years as a market and investment analyst, I've heard some truly outrageous claims. I've been pitched on fuel cells, assorted tiny metals and gemstone mining firms, black box trading systems that can't lose, and enough dodgy oil deals to lose 10 fortunes. I even met one gentleman who told me he developed a machine to convert ordinary tap water into fuel for his lawnmower. And we've all heard predictions the Dow would crash to under 5,000, leaving us with canned meat for sustenance. All while other sell-styled experts call for the same index to top 50,000 within 5 years. Look, chances are you've heard or read some of these same sensational claims, and if you're like me, you've probably developed a healthy sense of skepticism, an internal lie detector that saved you countless times from parting with your hard-earned investment dollars or getting involved with toxic investments. In fact, right now, you may be thinking my claim, there's a chart and a simple fundamental factor that can explain more than 80% of long-term stock market returns, sounds outrageous and too good to be true. After all, if predicting markets were that simple, wouldn't everyone be making millions? However, I promise you my research supports this claim, and in just a few moments I'm going to prove it to you with real facts and evidence so you can decide for yourself. You see, I believe many investors are making a crucial mistake right now. A mistake that quite honestly could be difficult, if not next to impossible, to recover from, even if your investment horizon is 20 or 30 years or more. That's not what I desire for you. So today, and only in this presentation, I'm going to do something I rarely have done in the past. Keep watching this presentation through to the end, and I'm going to show you exactly what I'm talking about and how to avoid this critical mistake before it's too late. First, I should probably introduce myself. My name is Elliot Gu, co-publisher and chief analyst for Deep Dive Investing Research. You may or may not have heard of me or the work of my firm. Over the last 20 years, I've made my career using powerful yet predictable market cycles to forecast major trends in stocks, commodities like oil, corn, and gold, even interest rates, emerging markets in the U.S. economy. 12 years ago, in a book I co-authored entitled The Silk Road to Riches, I used my research on agricultural cycles going back to 18th century England to call a tipping point in demand for meat. That tipping point, led by growth in emerging markets like China, propelled the prices of key feed commodities like corn and soybeans to record highs in 2012, producing gains of 763% in fertilizer producer Potash Corporation, 94% in oilseed processor Bunge, and 296.4% in an under-the-radar palm oil producer based in Belgium. In late 2008 and early 2009, while many talking heads in the financial media were calling for a second Great Depression, I called the bottom in global stock markets and recommended loading up on names like consumer finance firm Discover Financial Services, up 582.8% since the end of 2008. Railroad giant Union Pacific, up 387.1%, and even home improvement giant Home Depot, up 345.6%. More recently, you may have heard of the work we've done helping investors avoid the pain associated with the collapse in oil prices and disastrous declines in many energy stocks and master limited partnerships since the summer of 2014. 3 years ago, with oil near $100 a barrel, some pundits scoffed when we called for oil prices to eventually break down to $30 a barrel or lower. However, the critics were silenced when our timely sell calls and popular energy high flyers such as deepwater driller Seadrill, proppant sand manufacturer High Crush Partners, and upstream partnership Linn Energy helped our readers avoid declines of 90% or more and the elimination of dividends and distribution income. All these buy and sell calls, and many more, are a matter of public record through numerous appearances I've had on CNBC, Bloomberg Television, radio shows all over the US and Canada, reference in articles appearing on Seeking Alpha, MarketWatch, and Barron's, through investment research services I've founded, or my 2 investment books. However, that's not why I created this letter, and I certainly have no desire to boast or brag. I reference our success and experience calling some of the biggest cycles and trends in global markets because our research confirms that some of the most powerful cycles we followed for decades will converge over the next 2 years. I'm not exaggerating when I tell you this will mark one of the biggest money-making opportunities of my career. However, I'd be remiss if I didn't also warn you that it's one of the most dangerous parts of the economic and market cycle. To make matters worse, many investors are making a crucial mistake right now that could devastate long-term returns, threaten retirement goals, and income potential. And that's why I've spent a significant amount of time and money over the past 6 months preparing this letter, explaining all these risks and opportunities, and outlining 5 simple profit steps I'm recommending right now. Listen, late last week I hosted a webinar presentation for a small group of VIPs. These are primarily subscribers to my research publications that have been following me and my co-founder, Roger Conrad, for many years. In this presentation, I explained the one simple indicator that's statistically proven to explain 81.67% of long-term stock market returns. Even more important, I'll also explain the crucial and costly mistake so many investors are making right now. And I even go through the basics of my research on global market cycles and a few simple indicators you can use to pinpoint exactly where we are in the current cycle and how to profit from it. Look, normally I wouldn't make a recording like this available free of charge. However, I believe this information is so important and so crucial to your financial well-being that I couldn't just hide it behind a paywall. So I've decided to release it here today as part of this presentation. I must warn you, my talk was unscripted, and I didn't want to waste time editing this video to make it look pretty. I promise you I won't waste your time. Watch my short webinar presentation and decide for yourself.
First up, the big promise of this webinar was to show you the one chart that explains actually 81.57% of long-term stock market returns. And that's very important, long-term stock market returns. So what this chart is, on the left-hand axis, which is the vertical axis, I'm just putting the 10-year annualized return for the S&P 500. This is based on data going back to the early 1970s. And each of these blue dots represents a 10-year period of returns for the S&P 500. Obviously, they overlap, but these would be each 10-year annualized returns for the S&P 500. The horizontal axis on the bottom, you can see there the PE10. That stands for the price to earnings ratio, the 10-year price to earnings ratio. So I'm sure most of you are intimately familiar with the price to earnings ratio. You've probably heard it 1,000 times. You've probably used it. You've probably talked about it. You probably read about it, everything. It's simply the price of a stock or the price of an index that is divided by the earnings of that stock, earnings per share of that stock, or the earnings for that index. I mean, it's a classic valuation metric, right? The higher the PE, the more expensive the stock. The more you're paying, the higher the price for that level of earnings. So a classic valuation metric, again, you're probably very familiar with it. The PE10 is different from the PE only because of the following concept. When you have a booming economy, then obviously the earnings for your S&P 500 companies are going to be inflated, are going to be above trend, and growing above trend. And in a recession or a terrible downturn like we had back in 2007 to 2009, your earnings are going to be depressed. So to kind of smooth out that over time, the PE10 just uses an averaging methodology to smooth out earnings for the S&P 500 over time. Nothing I invented. This basic concept has been explored in academic literature going back to the 60s and before. Also, you may be familiar with Professor Shiller's book, which uses kind of a version of the PE10 as well to calculate the valuation of the stock market. So all I did on this chart is I plotted the price to earnings ratio for the S&P 500, the PE10 ratio for the S&P 500 in a given quarter, at the start of a given quarter, and I looked at the returns for the S&P 500 over the following 10 years. So let's say that on January 1st, 1975, the S&P 500 was trading at a PE10 of 15 times earnings. What were the returns over the following 10 years? And I did that every quarter going back again to the early 1970s. And the result is this plot you see here. And I also drew this red line through it, which is a statistically calculated line designed to show the trend in the underlying data. So what this shows you is very simple. When you buy stocks, it all goes back to the age-old adage, buy low, sell high. Yeah, buy cheap, sell dear. Buy cheap, sell expensive. Or as Warren Buffett likes to say in a 2008 op-ed in the Post, he said, you want to be greedy when others are fearful, and fearful when others are greedy. In other words, when the stock market's very, very expensive, you can probably expect that over the long term, your returns are going to be subpar. And if you look at this chart, you can see that quite easily. When the PE10 is close to 40 or above 40, on average, your 10-year returns from the stock market could actually be negative. So if you buy stocks when they're very expensive, as you can see on this line, when you move to the right on that horizontal axis on the chart, you see how those blue dots are all close to or even below zero. It's very hard to identify a 10-year period in the U.S. market history where stocks have actually been down because the market's risen pretty consistently over the years. But those times were all times when the market was very expensive and people ended up getting negative returns for the stock market over 10 years because they bought stocks too expensive. At the other end of the equation, look to the left on that lower axis when the stock market's trading at, let's say, a PE10 of 10 to 15. You can see there that you could typically expect long-term stock market returns over a 10-year period of 15% plus annualized, which is, of course, well above the average, which is a little over 11%. So if you buy stocks when they're cheap, the S&P 500 when it's cheap, you can expect to make above average returns. If you buy it when it's expensive, statistically, you will make below average returns. And if you look at this line, that R squared value on the chart actually tells us how well that trend line fits the data, and you can see that it is 0.8157. That means that it explains about 81.57% of 10-year stock market returns. So in many ways, when it comes to long-term stock market returns, almost, not totally, but almost, the only fundamental that matters is the price you pay for stocks at the beginning of the period. If you're buying stocks when the market's expensive, expect subpar returns. However, as with everything in the financial markets, there's a little bit of a twist to this whole narrative, and it's a twist to the narrative that costs people a lot of money. Specifically, if you follow that prior chart I showed you, which is very powerful, you can also go awry. How many times have you heard, just over the last few months, just over the last 6 months, that the U.S. stock market today is very expensive? And you know what? That's right. Currently, the PE10 for the S&P 500 is close to 27 times, which historically works out to well below average returns for those holding stocks in periods like that. So the stock market is expensive, and you've probably read that dozens of times this year in various outlets. I've seen it on TV. You've probably read it in dozens of periodicals, etc. However, there's a very important point out of all this. As I said, that chart valuations are very good at explaining long-term stock market returns, The truth is, though, that in shorter periods of time, 1 to 3 years, the correlation between the valuation of the S&P 500 and stock market returns is almost zero. In other words, valuations are great at telling you what returns are likely to be over a 10-year horizon, but they have almost no bearing on what returns are going to be over a 1, 2, 3, up to 5-year time horizon. So it's very important to make that distinction between the long run and the short run. The famous British economist, John Maynard Keynes, once said, in the long run, we're all dead. In other words, economists always like to talk about what the equilibrium price of something would be in the long run. But his point was the long run can be so long that it's almost meaningless to most investors. Most of us aren't going to be investing 75 years from now. I certainly won't. So what do we care about what returns are going to be like over many, many decades? The point is also to understand the short run is very important. The long run is made up of a bunch of short runs after all. And what this chart is it shows, I think it's a very powerful chart to show you what a typical stock market cycle looks like. And to create this chart, I went all the way back to 1937. Since 1937, there have been 12 bear markets in the United States, where the S&P 500 has declined from a closing high to a closing low. It's declined more than 20%. That's how I'm defining the term bear market. There have been 12 bear markets over this time frame. And what I did is I looked at the last 500 trading days of all 12 of those bull markets that led up to that top, led up to the bear market or the bull market high and then the bear market. And I looked at the first 1 year, 250 trading days of the bear market. So this is the last 2 years of the bull market, the last 500 trading days, and the first year of the bear market. And this is an average. It's a composite of all 12 of those bull market cycles over that time period. And if you think about that, I mean, it's amazing that it's been so consistent over the years. Because if you think about it, I mean, times have changed a lot since 1937. I mean, 1937, that was before World War II. Between 1937 and today, it was still the Great Depression was raging here in the United States in 1937. Between 1937 and today, the U.S. market has been through wartime, peacetime, bull markets, bear markets, and virtually everything in between. Booms, busts, everything in between. Speculative fervors, fraud, everything, all across the board. We've been through presidential assassinations, presidential resignation, you name it, politically, economically, fundamentally, we've been through every kind of market that's out there. But the final years of months of a bull market and the first months of a bear market look actually shockingly similar over this time period. And what you can see here is that on price return alone, in the final 2 years of an average bull market, the S&P 500 rises over 48%, 48% in the final 24 months of the bull market. If I add dividends to that, the return jumps to over 58%. So the stock market's up almost 60% in the final 24 months of the bull market. In the final 12 months of a bull market, the stock market returns almost 25% on average. The highest return was back in 1937. The final 2 years of the bull market, the S&P was up over 139%. And the worst return in the final 24 months of a bull market was a little over 30%. So my point is that you typically always see a final melt-up rally higher in the stock market in the final 2 years of the stock market. And if you look at that blue line before the market top, you'll see that there are very few even minor corrections in that line. Yeah, there's some little squiggles down, squiggles up, but more or less, it is pretty much an uninterrupted trend higher in the final years of the bull market. And usually towards the very end, it goes almost vertical. And I got to tell you, the stock market always looks expensive when it starts this final 2 year run. But if you miss out on that final 2 year run of the bull market, you're missing out on average returns, including dividends, of almost 58%. On average, that's almost half the entire bull market cycle return. So it's very, very expensive to sell stocks just because they're expensive. It's very, very expensive to you as an investor because you stand to miss out on what is by far the most profitable time of every bull market. One more point about this chart. We all learned growing up probably that the early bird gets the worm, right? Being early is better than being late. Being on time is better than being late, right? But in the stock market, that's not really the true with picking tops. If you're too early selling out, you stand to miss out on more than if you sell out, say, 3-6 months late. And you can see, even in the first 90 days or 100 days of the bear market, you're only giving back a small amount of the gain, certainly not as much as the 25% or so you would have made in the final year. So it's very important not to be too anticipatory of a stock market rolling over. And don't assume that just because the stock market's expensive, that has any bearing on what it's going to do over the next couple of years. It does have a bearing on what it's going to do over the next 10 years, but not on what it's going to do in the immediate period of the next couple of years. The other thing to keep in mind is this correlation chart. And what this shows is it shows the correlation between sectors within the S&P 500 and the index itself. Simply put, the higher this number, the more stocks are tending to move as a herd. So you might have remembered over the last few years, you've probably heard this term risk on, risk off. It was very popular back in 2011, 2012, 2013. And the idea was like the whole market was either going up or the whole market was going down. And it really didn't even matter what sector you were in. The whole market was reacting to various macroeconomic headlines and factors, like the debt crisis in Europe, or the fiscal cliff in the United States. All of these things were moving the market kind of in a herding way. So most sectors and stocks were moving in the same direction as the stock market. This is typical at certain parts of the bull market cycle. But what I did on this chart is I show you that the final years of a bull market, right towards the end of the bull market. And you can see on this chart I circled in green the period from 1999 and 2000s, the period from 2004 to 2006, and the period of last year and this year for the S&P 500. And you can see that correlations tend to drop off sharply in the final years of a bull market. Now, why is this important? Well, oftentimes in the middle of a bull market, when stock market correlations are very high, you start hearing stuff like, stock picking is dead. You can't time the market. You can't time the cycles. You can't time the sectors. There's no point in picking stocks just by an index fund. And that's because in those time periods where all stocks are moving as a herd, buying an index fund means that you get exposure to the whole market. It doesn't really matter so much that you pick your sectors. However, in the final years of a bull market and the first part of a bear market, typically sector correlations are very low, which means that the active stock picker, the guy who's out there getting into individual sectors, moving in and out of sectors, they're going to beat the person who just indexes. We're getting into that kind of a market right now. And that's why, frankly, we're so excited about getting deep dive investing, launched, and to tell you about some of these trends tonight, because we think that we're entering a time where stock picking is going to be very important. I mentioned that you probably heard the words, this market's expensive, a couple dozen times. I've probably read it a couple dozen times in the last week. That is kind of true. The stock market's trading at almost 27 times on a PE10 basis. But let me show you some other times that the market's been expensive. In October 2005, 2 years before the 2007 bull market peak, which was in October 2007, the S&P 500 sold for a PE10 of about 25.8 times. So not far off what it's trading for right now, just about a little over 1 point lower. Yet it still was up 35% in the final 2 years of that bull market. And 1998, which was 2 years before that March 2000 or summer 2000 bull market peak for the S&P 500, the PE10 of the market was at 40, which is actually much higher than it is today, but it still ran up another 43.2% in the final 2 years of the bull market. In 1988, 2 years before the S&P 500 entered a bear market, in 1990, the S&P 500 was trading at about the same valuation as today. The market was up almost 40%. And my personal favorite was December 1996. And some of you may remember that time, a little over 20 years ago, where then Fed Chairman Alan Greenspan uttered these famous words, irrational exuberance, to describe the stock market. And it sold off big time over just the next couple of days. He was saying that low interest rates may be inflating a bubble in the stock market, and people panicked that maybe he was right. Yet, over the next 3 years, the S&P 500 promptly ran up, and he was right. The S&P 500 PE10 at the time was over 30. Yet, over the next 3 years, the market was up over 107%, so it more than doubled. The most important rule of thumb to remember when you want to look to time where we are in the cycle. So in other words, selling stocks just because they're expensive is a loser argument. You don't want to miss out on this final 2 years of the bull market. How do we know that we're in the final 2 years of the bull market? Here's a good rule of thumb to remember. The S&P 500 has rarely, throughout history, peaked more than 1 year before the U.S. economy enters recession. So if the U.S. economy looks like it's weakening, then there's a danger that you're nearing that bull market top. If the U.S. economy is strengthening or accelerating or looks strong, then it's unlikely that you've seen the top of the market yet. Statistically, that's been the case in the U.S. Very, very rare that it tops out more than a year before. Let me give you just a couple of examples, the last two cycles. The stock market in 2007 topped out in October. The U.S. entered recession in December. So it only topped out 2 months before the U.S. economy entered recession. By late 2007, it was obvious to anyone who cared to look at it that there were some problems with the U.S. economy, that it was showing signs of weakness. In 2000, the stock market peaked out, measured by the S&P 500, over the summer months. The NASDAQ peaked out in March, of course, but the S&P made a marginal new high over the summer, and some other indices did as well. And the U.S. economy entered recession in March of 2001. So again, less than a year in the future. So how do we know what the state of the economy is so we know where we are in the cycle? I'm going to give you two very simple indicators that I use, two very simple indicators that you can go on the internet right now and find for free and monitor if you wish. Look, I was trained as an economist. I was trained, I did my graduate degree, including a lot of economics topics. And the thing is that, you know, what you learn about economists from that kind of experience is that they all have their favorite pet little indicators, right? And some economists like to look at literally 20, 30 different indicators to sort of get a feel for where the economy is. Personally, I don't like that. I'm a keep it simple kind of guy. I just want to look at a couple of different indicators that have a long track record of success, or at least a long track record of being right a lot more often than they're wrong. The reason is if you look at too many indicators, you're going to confuse yourself. You're going to have some indicators, you're bound to have some indicators pointing one way, other indicators pointing the other way, and you end up with sort of an analysis paralysis. One of my favorite indicators is the Conference Board's U.S. Leading Economic Index, LEI it's called. I like to look at the month-over-month change in LEI, and this chart shows you the cycles going back to late 1999. And what I like to look for is, again, the month-over-month change in LEI. The LEI is comprised of 10 widely watched economic indicators in the U.S., so it's sort of a composite indicator. And what I like to look for is periods where you have a one-year period where you have a lot of consecutive negative readings on the month-over-month change in LEI. And I can actually show you right here on the screen. So I told you that the U.S. stock market peaked in 2000, in the summer of 2000, and the U.S. economy entered recession in 2001. You can see over here, starting in the beginning of 2000 through the summer, there were quite a lot of negative readings for LEI, major negative readings for LEI, and only a few months where it was up. So that told you months ahead of time that there was a risk that the U.S. economy was going to enter recession, and that you should be thinking about a top in the bull market. Same thing happened in the stock market peaked out in October 2007. The U.S. economy entered recession in December. Look at all these negative readings going back to the beginning of 2006. So it really gave you more than a year of forewarning that there was risk of the U.S. economy entering recession. Right here, though, this is the last several months. There are very few negative readings, and mainly nice positive readings of 0.5 or higher. That tells me that not only is the U.S. economy not likely to slip into recession, but it's actually accelerating. By the way, you may see on your screen that the most recent reading, though, was a negative 0.2. This is mainly because of the storms that we had here in Florida, Hurricane Irma, and of course in Texas, Hurricane Harvey caused a temporary decline in some of the indicators that comprise the LEI. So I think that's the main reason that it was a negative number. But you can see mainly nice, solid, positive readings on that over the last several months indicates that we have more room to run for the U.S. economy, and it's probably accelerating.
So there you have it. Valuations are almost all that matters when it comes to long-term stock market returns. However, as John Maynard Keynes once said, in the long run, we're all dead. History shows that if you sell stocks too early because they're expensive, you're making a crucial mistake and risk missing out on the final euphoric melt-up rally that's characterized every bull market of the past 80 years. The fact is that stocks are always expensive at this stage of the cycle. My research confirms we're now in the final stages of this bull market, the most profitable, but also the most dangerous stage of any cycle. Simply put, history shows that some stocks will perform very well at this stage of the cycle, while others will downright lose money. It's the most profitable and the most dangerous stage of the cycle. However, the most important part of all isn't what's happening right now, but what you can do about it, including some specific profit steps you can take to make some serious cash at this stage of the cycle. Profit step number 1, how to play this rare quadruple sync cycle with this unique group. Listen, business, commodity, and market cycles are a fact of life. However, economic and market cycles in different parts of the world are not always aligned. Among the world's major economies, there's usually one that's acting as a global growth engine, and another that's the sick man of the world. However, here's what's crucial. The most powerful cycles show synchronized global growth. In other words, when a handful of simple leading economic indicators I watch for the big 3 developed economies, plus China, line up, typically only once or twice each decade, that's when investors can expect the biggest and most impressive gains in the stock market. And when all 4 legs of the quadruple sync cycle line up, I look at the industrials. The industrials are a downright weird economic sector. The group comprises everything from defense firms to transportation stocks like rails and airlines to firms that make heavy machinery and factory equipment. Even waste management companies, employment agencies, and firms that maintain uniforms are all part of this catch-all market sector that accounts for around 10% of the S&P. Listen, I love the industrials for just that reason. It's full of a bunch of companies that many investors overlook because they defy easy classification. And it's full of quite a few firms that most investors may have never heard of, but are actually a crucial part of their everyday lives. However, the real reason I'm so interested in the industrials right now is that this group is the economic sector within the S&P 500 that's most leveraged to industrial production and manufacturing activity. It's the single group that tends to perform best when the global economy is experiencing synchronized growth. I don't have time in this short presentation to go through all the indicators I watch and explain all the industrial stocks I'm recommending right now. However, I'll walk you through all you need to know and 5 specific stocks I'm recommending right now in a detailed 90-minute strategy session I recorded on the group. The best part is that for a strictly limited time, I'd like to give you access to this presentation, plus a quick bulleted executive summary of the main points, all with absolutely no risk or obligation. I'll show you how to reserve your exclusive access credentials risk-free in just a moment. However, first, I want to tell you about this. Profit step number 2, bottoms up. Listen, earlier on in this presentation, I explained why valuations are almost all that matters for long-term stock market returns. However, valuations can also help you identify opportunities in individual stocks. Just look at this shocking example. One of the most common valuation metrics for individual stocks is the price-to-sales ratio, the price of a stock divided by sales per share. Let's assume that starting in January 1997, 20 years ago, an investor bought the 50 S&P 500 companies with the lowest price-to-sales ratio. Each quarter, this investor rebalanced that portfolio to own only the 50 stocks with the lowest price-to-sales ratio. Look at this result. This simple strategy would have turned $10,000 into over $135,000 since the end of 1996, compared to just $50,189 for the same sum invested in the S&P 500 itself. However, most popular valuation metrics, including price to earnings, PE, price to sales, and price to book, all ignore one absolutely critical fundamental of successful stock selection. It's the single market factor that has brought more mighty companies to their knees, and it has ruined more great fortunes over the years than any other factor. I'm talking about debt. So let me ask you this. We all know excess debt is a huge problem for a company. So why would we use valuation metrics that don't take a company's debt burden into account? My research shows there is one valuation metric that does take debt into account. It's called enterprise value to free cash flow, EV to FCF. And it's one of my favorite ways to identify high potential stocks right now. In fact, over the past 18 months, selecting S&P 500 companies with the lowest valuation on this metric has trounced the broader market by nearly 10 full percentage points. I want to send you all my research on this powerful value metric today, plus 4 stocks I'm recommending right now that screen well on enterprise value to free cash flow. And in just a few minutes, I'll explain how you can gain access to this crucial research immediately with a no-risk, no obligation trial charter membership to deep dive investing. However, first, that brings me to this. Profit step number 3. To make money and earn hefty yields in real estate, think small and follow our checklist. Stephen Ross, Richard Lefrak, Ted Lerner, and of course, US President Donald Trump are all among the world's billionaires who made their fortunes primarily through real estate. The good news, you don't need to be a billionaire to make serious money and earn impressive yields in real estate, thanks to the real estate investment trust structure created in the US back in 1960. REITs are nothing more than publicly traded companies that own or finance income-producing real estate properties, including apartment buildings, office buildings, shopping malls, even cell phone towers and data centers. However, I must warn you, most REITs today are very expensive. You're paying more for less yield and income than almost any other time in the history of the industry. However, that doesn't mean there aren't bargains in the group. You just have to look beyond the headlines and the handful of large REITs most investors buy. You see, my colleague and income investing expert Roger Conrad has developed a 4-part checklist to identify the best bargains in the group. This simple checklist pointed him and his loyal readers to the data center REITs back in early 2014, and this same process is guiding him to some incredible bargains right now. I don't have time to go through all the details in this letter. However, here's the gist. Look for REITs with a strong underlying business and visible upside to rents. Look for REITs that cover their distributions using funds from operations, or FFO, leaving ample capital left over to fund growth and expansion of their property portfolios. Excess debt is the biggest enemy for the group. Look for REITs with below average debt loads and relatively few near-term debt maturities. Finally, calculate the growth yield by adding yield in percent to the annualized distribution potential, and focus on REITs where the growth yield adds up to 10% or more. Look, there are 224 REITs in North America alone, and only a handful fit Roger's stringent checklist criteria. Many of the best REITs to buy right now are not the large cap names that dominate the S&P 500 real estate index. It's not the stocks that are major components of the popular exchange-traded funds and exchange-traded notes that so many REIT investors buy for diversification. As I explained earlier, many of those popular and widely held REITs and exchange-traded products are trading at near record valuations and actually represent potentially very dangerous investments. Today, I want to give you access to Roger's detailed presentation on REITs, including his top high-yield, fast-growing REIT picks to buy right now, plus a rundown of some of the most dangerous and most overvalued REITs you should sell out of your portfolio right now before it's too late. Best of all, for a limited time, this detailed REIT strategy session and Roger's Quick Start Executive Summary is available with absolutely no risk or obligation only through this website. And those are just 3 of the profit steps we're recommending right now. I'd also like to send you all my research on shale oil's biggest threat and biggest opportunity. Trouble and opportunity built on a subprime foundation. The right and the wrong way to buy into the alternative energy boom while earning a tidy yield on your investments. Why investing in quality and how it can help you profit in good and bad markets. Junk bonds, risks and opportunities. Listen, I know you've probably been reading a lot about how overvalued the stock market is right now. However, missing out on just the last 2 years of a bull market can be a very expensive mistake. Since 1937, investors selling out too early have given up average gains of 58%. No investor can afford to give up on a return like that. And you're probably also read about how low-cost index mutual funds and exchange-traded funds have been beating active portfolio managers over the past few years. However, just remember, market correlations tend to drop sharply in the final years of a bull market. That means some stocks are big winners, while other sectors and groups lag the market significantly. In short, the final years of a bull market are usually a stock picker's market that favors more active management over indexing. In fact, when the talking heads on financial television start preaching the doctrine of buy, hold, and forget, like they did in 2000 and again in 2007, you know we're entering the final years of the rally. I don't want you to miss out on this opportunity, and to help you profit from what I believe could be a dramatic rally, I'm going to do something I've never done before for this service. Please just give the work I've done a look, and I believe you will have all the information you need at your disposal. The best part is you can take a look at my research and receive everything I've mentioned here for 2 full months, that's 60 days, at absolutely no risk or obligation. Simply click the Start Your Risk-Free Trial button below and let me know you'd like to take a trial subscription to Deep Dive Investing today. And I'll rush you a username and password for our secure website, granting you immediate access to all the detailed presentations and strategy sessions I've outlined in this presentation today, plus concise executive summaries for all of our themes and recommendations to help you get started profiting immediately. To my knowledge, there's no financial advisory service on the market today quite like Deep Dive Investing. We don't just scratch the surface of the themes, industries, and stocks we cover. In each issue, we want to give you a thorough understanding of the fundamentals that drive our big idea investment themes, so you'll have the conviction to benefit from our best of the best ideas and recommendations. Roger and I attend industry conferences, participate in management conference calls, scrutinize financials, and leverage our contacts across the industries to track down the data, charts, and key fundamentals you need to make an informed, high-conviction buy or sell decision. It's like being a fly on the wall and receiving an executive summary of all the best ideas and research presented at our weekly company investment meetings. And all our deep dive research is delivered to you in a novel and easily digestible format. Issues are delivered at least 20 times each year in the form of a detailed video presentation that includes a slide deck in convenient PDF format, packed with all the charts, financial data, valuation metrics, and background research you need to gain conviction and an understanding of our top ideas. And just to get you up to speed so you can act quickly on our picks, we publish a short, bulleted executive summary of our main conclusions and recommendations with each new issue. Roger and I have been discussing a service like this on and off for years, and we just launched Deep Dive Investing about 6 months ago to a small group of beta testers. It's quickly become a hit with our readers, and we've decided to expand the service even further. Specifically, we already track the performance of all our recommended stock ideas in Deep Dive Investing. However, we just announced the launch of our exclusive focus list. The focus list includes a short list of the specific stock recommendations, both growth and income, we believe to be the most timely based on a host of technical and fundamental factors we review weekly. These are the themes and stocks you should buy first to take advantage of our advice. And we're even more excited about our exclusive Managed Portfolios feature, that we'll be rolling out in the service over the next few weeks. You see, deep dive investing isn't just another stock tout tip sheet like so many investment research services on the market today. We believe that just recommending stocks to buy is just the first step to investing success. We want to help you decide how much to allocate to each of our recommendations, when to buy these stocks, how to buy our recommendations, and specific buy prices and profit targets. Also, how to hedge yourself and protect your downside in weak markets. To guide you, we're creating a group of separate managed portfolios, each aimed at investors with different objectives and risk tolerances. For example, our absolute return portfolio is for investors looking to earn a positive return in any market environment. It includes specific recommended allocations to a portfolio of stock recommendations plus market hedges aimed at protecting your downside during market downturns. In short, we believe the absolute return portfolio will help you take advantage of the melt-up market rally today and protect your downside during the coming bear market. And then there's our enhanced income portfolio we're planning to launch over the next few weeks. The enhanced income allocation is aimed at our readers who like to buy and sell options on stocks and indices. Specifically, we recommend option strategies such as selling puts and selling covered calls to squeeze more income and more profits out of our recommendations. Deep dive investing includes specific portfolio recommendations and allocations for investors with different goals and objectives, and will never leave you hanging or guessing about which stocks to buy or how much to invest in each recommendation. I guarantee it. The truth is that once we launch these new features for the deep dive investing service, we'll be raising the membership price to $1,999 a year or $599 quarterly through a convenient billing option. However, for a strictly limited time, and only through this website, we've decided to offer deep dive investing trial memberships at our special charter rate, representing a huge discount to that full membership price. Even better, charter memberships come with our popular Forever Guarantee. Simply put, should you decide to continue with your deep dive investing membership beyond our trial period, we'll lock in your annual or quarterly rate for as long as you choose to remain a member. You will never be asked to pay a dime more than our charter rate to renew your subscription, regardless of what we're charging new members in future. And we realize it may take you some time to review our deep dive investing service and start taking advantage of all our recommendations and advice. So, for a strictly limited time, we're extending our no-risk money-back guarantee from 30 to 60 days. Start your risk-free trial to deep dive investing today by clicking on the exclusive button below this video and review the service for 60 days. If you find deep dive membership isn't for you, for any reason whatsoever, or if you think it's not worth every dime of the subscription price, simply cancel in the first 60 days and we'll refund your entire subscription rate with no questions asked. I guarantee it. Look, Roger and I have charged as much as $9.99 per attendee to give a detailed market presentation, including our top recommendations and the profit themes we're following. Just the sort of presentations you'll be receiving from me, Roger Conrad, or both of us together every single month as a member of Deep Dive Investing. And services that offer specific recommended portfolio allocations and strategies for selling covered calls or puts to earn additional income from stock recommendations sell for more than $4,000 per year. So we believe our regular membership rate of $19.99 a year or $5.99 a quarter already represents a more than fair price for our readers. However, as we roll out the new features of this service, we've decided to create a special charter membership category at a roughly 50% discount to our regular rate. For the first 25 readers to respond to this presentation, our charter rate is $9.99 a year or $299 per quarter. And as I mentioned before, we're only asking that you give Deep Dive Investing a test drive. Sign up for our trial membership today using the Start Your Risk-Free Trial link at the bottom of this page. Take advantage of our special charter rate, all our features and model portfolios, and check out our detailed archives, including all of the strategy sessions and themes I've covered in this letter today. And only then decide If deep dive investing isn't for you, cancel in the first 60 days and receive a full refund of your membership rate with no questions asked. Please click the Start Your Risk-Free Trial button below to get started today.